The death benefit is the most prominent feature about life insurance. It's certainly the thing people think about most when they think about life insurance, but it's not the only benefit of owning life insurance.
You can use your life insurance cash value as collateral to take a policy loan, or you can also assign your life insurance as collateral to use other people's money.
And if you own a business, you can use life insurance as a benefits program and to keep critical employees. We're going to talk about all this, starting with the easiest way to use policy as collateral, and that is with a policy loan.
Policy loans are easy to use. And that's something a lot of people don't realize until they actually take a policy loan. It's not like going to a bank and signing away your firstborn. You can take a policy loan by just requesting it. Sometimes it's just over the phone. Sometimes you sign a form depending on the amount.
Well, a policy loan is a little bit confusing in that it sounds like you're borrowing money from your policy, but that's not really what's happening. You're using your policy's collateral, or the paid up insurance portion of it, that represents the cash value. And now you can put that up as collateral and the insurance company will loan you their money.
And so even somebody that has bad credit, if they start a life insurance policy and they build up the cash value there, they can take a policy loan and their credit score doesn't have anything to do about whether the insurance company will give them a policy loan because it's a fully collateralized loan.
That's so different than putting money into a piece of real estate or your home and then saying, oh, I'm running into some financial difficulty here and going to the bank. Because now in a bank, you still got to go through all the underwriting to get a loan. In a life insurance policy, you've got that collateral. All you have to do is sign a paper and boom, the insurance company says, here's your money.
Well, a lot of people in today's world, they have credit card debt. And even people that seem to be doing well on the surface, oftentimes they still have credit card debt. It's amazing how often that people have credit card debt. It just kind of creeps up there. And so if we take an example of somebody that has $20,000 of credit card debt at 19.99% interest.
That's below the average right now.
What's the average right now?
The average is over 24% for 2024.
Wow. So that's significant.
That's what I'm hearing from callers too. People I'm
Yeah.
talking to on the phone, they're talking about credit card debt being at 24%. And I'm hearing even some higher numbers.
I've seen interest rates on credit cards up over 30% before. That's not as common. So 19.99%, we're going with a nice round number, relatively low compared to what the average is. If you make the minimum payment on that, then that's going to come out to around $333.29 per month. And then you're going to pay that for probably around 40 years based on the way minimum payments
Oh, okay.
work.
I have something here. You just said 333, how many cents?
29 cents. Yes, the cents do make a difference.
Well, wait a minute. You just said it's kind of a round number. So why did you say that?
Minimum payments, it's not always going to be exactly 40 years. I've figured out, done some math on different minimum payments. They don't tell you exactly what they're figuring them based on, but usually you put together the principal and the interest rate, it's going to be a term of about 40 years. So if I want to calculate a minimum payment backwards, I put in a term of 40 years and then I figure out what the payment would be.
Couldn't you go just the $333?
Well, if you go $333, you're never going to pay this credit card off because the interest will accumulate faster than
So
that.
just that
Just
29
the 29 cents makes a huge
Wow.
difference. And if you pay $334 a month, then you're going to end up paying the credit card off in 30 years and 3 months. So you're almost going to cut 10 years off the time. It's crazy.
I've read
The
some
cents do
reports
make a
that say the minimum payment is based on a figure of paying the principal back at 2%.
Okay.
But that's not covering the interest. So they add the interest on top of that minimal 2% of the principal.
Interesting.
And that's why sometimes if you adjust this 29 cents off something, you'll never pay it off.
Yeah, it's huge. So if you actually made this minimum payment for all 40 years, you'll pay over $139,000 in interest to pay off that credit card.
And what was the balance initially?
$20,000.
Oh my goodness.
Yeah. That's credit card interest for you.
So this might be why somebody would want to take a loan from their policy to pay off this
Exactly.
interest.
Of course, nobody ever thinks they're going to just pay the minimum payment. They think they're going to pay this credit card off sometime.
Well, of course.
So maybe they'll throw a little extra money at it. And let's say they put $444 a month toward this credit card. They could have it paid off in 7 years. But of course, that often doesn't happen in real life.
Right.
So they'll throw $500 at it one month, and then they might just make the minimum payment next month. And if they do that for a few months, then pretty soon the balance works back up. It's not that clear cut. But if they can pay $444 a month, 7 years, they'll have that paid off, and they'll save quite a bit of interest. They'll only pay about $17,000 in interest.
But that's another $111 a month
It is.
that they may not be able to afford. It's like the client I was talking to yesterday. They've been with us 6 years, and they've got over $16,000 of credit card debt that they're paying over 24% on. And their minimum payment is $1,000 a month that they're putting toward this.
That's significant.
And that's really crunching their cash flow.
Mm-hmm.
So by taking a policy loan, which they've had for 6 years, and the money's just sitting there, they took a loan.
So they have at least $16,000.
They have more than that. So now they can switch the debt from the credit card company back to the insurance company. And when they repay it to themselves or to the insurance company, it's just reestablishing the $16,000 that they borrowed.
Excellent.
So they can use it again. Plus, if they will continue to pay as if they were paying the credit card off to the insurance company, they'll have an extra $2,000 of interest that they've collected for themselves.
That's exciting. Now, for these people, it might seem like a complicated process. I'm taking a loan to pay.
Oh, all you have to do is call our office and get a form to sign, and they send you the money.
In this example of $20,000 of credit card debt that we were looking at, if they had the money in their policy to take a policy loan, okay, use the policy as collateral. So they're not actually using their money. They're using the insurance company's money. They pay off that credit card. They basically just transferred that from a 19.99% credit card to a 5.5% policy loan.
Mm-hmm.
They could, if they make the same $444 payment that they would have to make to the credit card to get it paid off in 7 years, they make that back to the policy loan payment, they're going to have the policy loan paid off in just over 4 years.
Wow.
And they only pay like $2,200 and some dollars of interest, which leaves another $15,000 of cash flow that they get to recover and keep instead of paying to the bank. And that's not all, because the life insurance policy, they've continued paying the premiums on it during this time, because everybody should be saving something, even if you're working to pay off debt. And if they've been doing that, then in this particular example, they paid about $43,000 in additional life insurance premiums over the next 5 years, but their cash value has grown by $45,000 to $50,000. And so the cash value growth has even offset the interest they did pay on the policy loan.
Oh, absolutely. That's Michelle. I remember when we first started doing this, you came to me and say, "Why are we still paying cash for everything, Tom? Why don't we put most of our business expenses on the credit card with American Express?" Because at the time they were paying 3 to 4% on everything we purchased. That's like a cash rebate every time we purchase something. And then you said, instead of using our cash all month long, let's just keep it. And then at the end of the month, we can pay the credit card off and not pay a dime of interest to them. And then even better, why don't we take a policy loan and pay the credit card off? And then over the next couple of years, let's just pay the insurance company off like we were paying the credit card. And now the interest that we would have paid the credit card plus all the principal that we had used to buy the assets in the business was back in our policy, plus the interest plus the policy growth like you were talking about. It's a no-brainer once you really understand the whole process.
It is.
Wasn't I brilliant?
You are brilliant. Still are.
Now, let's say that this person with $20,000 of credit card debt doesn't have $20,000 that they can borrow in their life insurance yet. Should they wait how many ever years they need in order to build up that $20,000?
They don't need to.
They don't need to. Because even if they could just borrow $6,000 and get that chunk paid down, that's $6,000 that they're not paying 19.99% on anymore.
Absolutely. In fact, if they've got multiple credit cards, it might behoove them to concentrate on one, pay the minimum payment on the others.
Yes.
So that when they get this credit card that they're concentrating on is down, their monthly payment to that one, they can put extra money toward that because of the cash flow they're freeing up. And they'll kill their debt faster that way than if they just sporadically hit this one and that one. And because like you said earlier, that just causes the interest rate to climb when you're not concentrating on one.
When you have multiple credit card debts, you definitely want to be strategic about which ones you go after first.
So I'm sensing that there could be a caution about this, though, because financially it makes sense. But if you've got the mindset, oh, I've got a $20,000 balance on my credit card, and you go and you pay off some of it, It could be real easy to get that card out again and keep swiping so
Yeah,
you're
it
right
looks
back
like
up
it
at
has a lower
20,000.
balance. Yeah.
So
And it
that's
happens. It might sound silly, when you pay it down, but we see it happen all the time. So that is a caution.
so
Worthwhile
that's
caution.
not a problem with a life insurance policy. It's an issue with human habits.
Hmm.
And so those human habits need to change while you're using this great tool of the life insurance to pay down the debt.
Well, years ago, we wrote the book, Winning Your Financial Game, and we talked about the 3 Ds that make this whole process work: desire, discipline, and determination. And the determination is you got to start making different choices in life. The discipline is you got to follow a course and have a plan and stick to it. And of course, everyone desires to be wealthier than they are. That's a no-brainer.
So we've talked about using life insurance as collateral for a policy loan, but there's also a way we can use life insurance for collateral without taking a policy loan. Getting into that a little bit, what if you can access a loan from a bank at 3% interest and the policy loan rate is at 5% interest? Is that a situation where we might want to use the life insurance as collateral?
Well, many banks and credit unions recognize the value in participating whole life insurance, that paid up insurance that produces equity called cash value. You can collaterally assign that to a financial institution that recognizes that, and they'll be happy to loan you their money. Because if you don't pay it, they'll just go confiscate it out of the insurance company.
Mm-hmm.
However, interest rates change frequently, and we've seen that, and we've had clients use their policies as collateral assignment. And now, because interest rates are rising at traditional institutions, they're saying, wait a second, if I would have just taken a policy loan from the insurance company, the interest I'm paying would have been much lower. And so they're going back and reversing those collateral assignments so that they are going to pay the insurance company back, which is restoring their, quote, line of credit or cash values so they can use it again.
We've even seen people do collateral assignment on using a term life insurance policy when the bank just wants to have a death benefit on the person that they're lending money to. So you're still going to have to go through the bank's underwriting process. You're still going to have to prove that you can make the payments and all that because the bank wants to see that. Okay, but it can make it easier. If the bank needs life insurance coverage, maybe you can get that cheaper with a policy that you individually own and collaterally assign rather than getting one the bank would want you to buy.
After the break, we are going to talk about using a policy for collateral assignment to keep critical employees.
You need homeowners insurance for your home, auto insurance for your car, and life insurance for your life. Did you know many Americans can get $1 million of life insurance for less than the average cost of a cup of coffee per day? At this rate, who wouldn't want $1 million of life insurance? For many families, $1 million would pay off the mortgage, send the kids through private school, finance college, pay off debt, and leave some extra money for future use. We want to help you with all your insurance needs. Contact us by email, text, or phone.
Good employees can be hard to find and even harder to lose. There's a lot of different ways you can try to keep good employees, but we're going to talk about one of them that you may not have thought about.
John Wanamaker, the father of the modern department store back in the early 1900s, offered health and life insurance benefits to his employees. And after World War II, companies were concerned about how to keep their employees, and they couldn't afford to hire or to increase their wages. So they started offering benefits. And one of the benefits that many people experience at their jobs is a little bit of life insurance. So it'll be company owned or company offered through the company, that as long as you're with the company, you have a certain amount of death benefit that you can use for your family. So using life insurance for benefits can happen in many forms, and the death benefit is one of those.
That was back in the days, too, when people really valued life insurance, because many people were leveraging their life insurance to pay off cars or to pay off their houses, because we were still in a depressive state at that time for the economy. Or even if you go back even further, during the Great Depression in the late 20s and 30s, people would go to their life insurance to continue to make payments on their house because the banks were saying, you can't withdraw your money.
By the end of the 1920s, there was a life insurance policy in force for every man, woman, and child in the United States.
And
Maybe not everybody was insured, but there was enough insurance
Yes.
policies in force to cover all of that. So that was resources that many people turned to when their finances had trouble during the Great Depression.
And that would be cash value life insurance because there is cash value to access. Where nowadays, a lot of times the benefit, or most of the time, the benefit that's offered to the employee is a term, which if they're working there at the time, then they get so much death benefit, but no cash value.
Right. In fact, as it's worse than a term, it's a group term policy. So that if they ever leave employment, the premium on it is going to go skyrocketing up and they're not going to be able to afford to keep it, most likely.
So, what we want to talk about is what kind of insurance would help us retain a critical employee, an employee we value and don't want to lose.
That's obviously going to be life insurance that builds a cash value, permanent life insurance. And we see big companies often using permanent life insurance today to create reserves to back up their pension programs or other benefit programs, or to reward key employees that they want to keep, like executives and people like that they want to give benefits to without causing a big tax issue.
Banks do this too as well. Bank of America has done this. Comcast has done this. Exxon did this. University of Michigan did this to their coach, Jim Harbaugh. It's a way to retain employees by giving them an incentive that they don't have to currently pay taxes on.
So, can you give us an example of this? Maybe something that one of our own clients has done.
Well, one of our clients recently approached us and say, how can I use this to entice my employees to stay with me? Because it's hard to find good employees. And like I said earlier, it's even harder to lose them because it's
a huge time commitment. I mean, you
and a
spend
financial
time.
commitment as well.
Yeah, you spend time and money to train this employee, get the wheel going so that your business is working well. And then if one leaves, well, suddenly it's not working well.
Yeah.
And you've got to make up that difference. And so life insurance can be a simple solution to make up that difference and help that employee stay so you don't have to, you can just continue with the same momentum you have.
So in this case, he decided that he would offer his employees, and there was just two of them that he really valued and didn't want to lose. He would offer them to buy them a life insurance policy. And he would retain the ownership of that policy, but they would become vested in the cash values the longer they stayed with him as an employee, the more they would be vested in it. So very much like a 401k, there's a certain amount of time that you can have to stay employed before you're vested in 100% of what your 401k balance is in many situations. So it's a non-qualified plan, meaning that the government isn't sticking their nose under your tent and telling you what to do about it. There are some limitations, and we have to be careful that we follow those so that the IRS doesn't get involved in it. But it's a great way to offer an extra benefit to an employee because that's going to be money that they can borrow and use in the future. And in this case, the employer was very generous and he said, look, if you die while you're in my employment, I'm going to give 50% of the death benefit to your family.
That's a policy that if they stay long enough, they get to keep that long term. Whereas the group life insurance that many people get through their work, if they leave, that benefit's totally gone. So the fact that they're able to be vested in this and keep some of it over time, that's wonderful.
So he's giving
Good deal.
50% to the employees' beneficiaries, whoever they name, and he's retaining 50% for his company because there would be a loss if that
Yes.
employee passed, and
And it will recover the
he's
costs
going to
that he
be off
paid.
balance again.
Yeah.
Yes.
Because he's buying the premiums, it's going to recover his costs, and it's also going to give him the money to find someone to replace that person if he can.
Now, the life insurance is the financial tool that is being used. The actual agreement of this situation, how much they're vested, at what point, that can be determined between the employer and the employee in some sort of a contract saying this is what it is, and they can promise certain numbers based on the guarantees that are in the whole life insurance that they are using as the tool to back up this agreement.
The only involvement that the government gets in it is that you have to sign a form letting the IRS know that this is the arrangement so that when the death happens, there's not taxes on that gain.
So this
So
can
it's pretty
be
easy.
a great way to provide value for your employee and be able to preserve your business and continue to keep it running smoothly.
When we think about any big promise like that, whether it's benefits, whether it's buying equipment, whether it is buying appliances, anything, we always break it down into payments. And so that's why using the life insurance as collateral is so beneficial in these circumstances, because it's just a matter of where payments are made. You think about if you're going to lease a piece of equipment, you're going to make payments to the leasing company. If you're going to finance a piece of equipment, you make payments to the leasing company. If you're going to finance benefits, if there was such a thing, I don't know, no, you're going to make payments to it. But most of the time, the way that people finance benefits is they're going to make payments to some sort of cash payments to an account that's going to grow over time. Well, life insurance can be used for that as well. It's just a matter of where you're making the payments. Is it on the back end of the financing, or is it on the front end of a savings program?
Well, you drive down the road and you see a trailer pulling a piece of equipment. It's a private individual, but they're a corporation, most likely, or some type of business. And you think, well, not much about it. But when you start thinking about what are they paying to insure that? I mean, they could be paying $20,000, $30,000 a year in automobile insurance because they're carrying a lot of weight on the road and they're a target for people. So another way to use collateral is to say, okay, I've got this life insurance. I can finance my liability insurance by borrowing from my policy. And then when I pay it back, I'm getting that money back, plus I'm getting the growth in the policy, instead of having to go to the bank and get a loan to pay my liability insurance this year.
That's huge because you are going to make the payments either
Absolutely.
on the back end of the financing or on the front end of saving up for it. So why not save it in life insurance? You pay the same cash flow, but you get to keep the growth of the policy. We've introduced the element of collateral assignment. That's why it makes sense in the long run, because it's easier to use other people's money, and that way yours can continue growing and you don't lose that compounding curve.
I remember the first time I was introduced to this concept, I had a friend take it to a CPA to read. And the CPA told him, anytime you own the company that you're borrowing money from, you come out the winner. And that's what's happening in life insurance. We are part owners of these mutual companies. And so when we borrow from that company and we pay them back interest like we would pay other people, we get the profits from that, our share in the profits.
Something that's really nice too when we do use the life insurance as collateral with a policy loan is we get flexibility on some of the terms of repayment. So if you're financing your liability insurance, you got to make the payment every month to the bank, or they're not going to lend money to you for your liability insurance next year.
That's correct.
And you're going to still have interest on it. But if you take a policy loan from the life insurance company and you have a tough month, or maybe a tough couple months during the year, well, the insurance company isn't going to come barking down your neck to get the payments. That's great.
Yeah.
You have the flexibility. You could just make interest-only payments
Just
for
the
a
interest.
while. You could even let it add to the loan balance for a few months if you needed the extra cash flow. That's not a long-term solution, but it is a wonderful short-term solution. You have flexibility. The ball is in your court now.
Well, back when we used to lease an office space, if we could get the leasing company to take a payment up front for the entire year and give us a discount, so like maybe give us a month free rent if we paid then we could make payments by borrowing from our policy and pay that lump sum right up front for the whole year. And then structure payments over a 2-year period of time that were half as much as what our lease payment was per month. And in 2 years, we'd recover that. But by the second year, we would have enough cash value in our policy to pay the lease again. Now our payment to the insurance company is back what our payment was for the lease to begin with. We weren't paying any more, but we were recovering the cost of our lease perpetually.
So what you basically did is you stretched cash flow out so that you could save more on the front end and get a compounding curve started.
Cash
If
flow is
you
key.
control
That's
there.
the key thing in any business and any personal finance. Cash flow is key. If we can manage our cash flow, we can manage to keep more of the money that we make.
So here I am sitting here and my head's going back and forth as I'm listening to you guys just bounce these different strategies back and forth. And it reminds me of the quote by Albert Einstein that imagination is more important than knowledge. So we get this knowledge about life insurance and borrowing and how we can use the cash values. And then it's just a matter of imagination. Now we've talked about paying insurance and like liability insurance for trailers and equipment. And we've talked about leases, and we've talked about keeping critical employees and getting a loan from a bank, how to collateralize that through life insurance. We've talked about a lot of ideas here, and it's all because we have the basic knowledge, and then it's our imagination that we put to work. And that's what our listeners can do too. Start thinking of their ideas, and we can help implement those ideas.
Well, real quick before we wind up today, you want to tell us how partners can use life insurance for a buy-sell agreement, funding that type of arrangement?
Absolutely. There's no business plan that's complete until you have an exit strategy. Life insurance plays a huge role in funding that exit strategy. So when a business is starting, oftentimes cash flow is tight. There's not a lot of extra capital flowing around. And so someone might want to start that business with a convertible term policy on their partner. That way, John, if you or I in business together and I pass, then might have to sell the business to pay off my estate because 50% of my equity has to be recovered.
I could have a hard time too, because I'm going to have to figure out how we're going to cover the work that you were contributing to that partnership.
Right.
Yeah.
So if you would buy a life insurance policy on me, that would, if I die, that death benefit will fund that buyout, and vice versa. I would buy one on you. Okay. And if there's more than that partners, then it becomes just a little bit more complicated, but it's still doable. And then because it's a convertible term, as the cash flow comes in, we can convert those term policies to whole life policies that start developing cash value so that we can leverage the cash value to do the things that we've been talking about.
Well, there are so many good ways to use life insurance, but none of them will help you unless you have good life insurance. And that can be hard if you don't know what to do or how to get started with good life insurance. Next week, we're going to talk about how to get started so you can have all the benefits of owning good life insurance.
If you have good life insurance, it makes everything you do financially better.
Next week, we're going to talk about how to get started with good life insurance right here on Wealth Talks.